Hey everybody, what's up? Today we are doing another stock analysis. We'll be going over Vail Resorts. So they basically do like skiing, lodging, real estate. That's basically it. So their company is very seasonal, which we'll get into later with their quarterly reports. But overall, it looks like a pretty solid company. So if you're interested, we're going to go through everything that has to do with this company, financials, earnings reports. We'll look through their chart. So make sure to subscribe if you haven't. I do these videos every single day of the week, mostly. And yeah, let's get into it. So, looking into Vail Resorts, we could see they have a few different things here: mountain lodging, real estate. They cover operation of mountain resorts and ski areas, and they have a few different other things listed here. But let's go over some industry metrics. So, average daily rate, I'm assuming, is how much their customers pay per day. And we can actually see the estimates for 2025 here. So, it's actually expected to kind of decrease towards the second half of the year. But also, you have to remember this company is very seasonal. I'd imagine most of their income is from the winter because it's mainly ski resorts. But it just kind of depends quarter to quarter. Another thing is occupancy percentage. I'm assuming that's how many people go to their resorts, and I'm assuming this is in millions of people, so 34 million people. That would kind of make sense. This is total skier visits, so you could see again the numbers of overall people visiting their resorts. So I don't know if occupancy percentage is how much their buildings were occupied. I'd imagine like the percentage that they were occupied in, and then you could see total skier visits. So it looks like their end of the year quarter actually isn't that crazy, and then January quarter and April quarter are their busiest, and then obviously the July quarter is not very busy because skiing, but which is kind of surprising. You would think that the October quarter as well would kind of be um, busier, but apparently not. So anyway, moving past it, we also have effective ticket price, which is probably just tickets for their skiing. Which honestly, in my opinion, as a person who has skied before, this is very expensive. That's kind of crazy. But anyway, moving on. Market cap is just below 7 billion, 5% dividend yield. That is fairly high for any company, which is definitely something to consider if you're investing. Target price is at 202 and long-term growth rate is at 19. Right now our price is at 177. So a little bit of a ways off there, which is interesting. Overall growth summary looks fairly solid across the board. All of the long-term, other than book value per share, which isn't too important. All of the long-term metrics are all positive and fairly consistently positive, especially the dividend growth. 10-year CAGR of 21% as an estimate is pretty solid. I mean, you'll be getting paid pretty well by this company just through their dividends, which is pretty good. But other than that, let's start moving into some of their financials. So this is over the past few years. You could see in 2024, they actually had a slight decline in sales. But however, they are significantly past where they were pre COVID, which is good. It shows that they've been growing, even despite that being kind of like a travel focused company. It's pretty good to see that they're past where they were before COVID. But other than that, everything looks fairly solid. Net income is okay. One thing I will say is they are making less net income now than they were before. So actually, they're making more revenue but less income, if that makes sense to everyone listening. Which is not great. Clearly, they lost some of their profitability trying to drive sales growth after COVID. So that is definitely something that needs to be worked on. Even in the past 2 years, in 2022, they had 350 million in net income, and now they're at 230. So not great there. Definitely something that will need to be addressed fairly soon. And we could actually see if we do go into the quarters. Now, one thing to remember is very seasonal companies. You could see their October quarter, their July quarter are both very underrepresented, while the other two are very overrepresented. So, looking into their net income, we could see 362 million in just April, 219 in January, but they are taking very large losses in October and July quarters, which is kind of surprising. You would think that they would cut costs significantly in those quarters by just operating less, but it seems like they're just struggling to do that, and they have been struggling to do that for a while. So I'm not really sure why. Their cost of goods sold do get cut in half, but their sales are a fraction of what they should be. So overall, it looks like the seasonality for the company is not working out very well to the point where sales are growing and net income is decreasing. So definitely something to pay attention to in the future, something very important to look for in future earnings reports. Other than that, their total shares are falling. Um, Not very well. Actually, over the past three or so, just about 3 years, they have been slightly decreasing, which is good to see. But again, the main thing we're looking at here is those problems with net income. Now, their net income is still positive, to be fair, but it is definitely something that needs to be addressed in the future when your sales are growing and your net income isn't. That is not great. Next up is their balance sheet. We could see their assets have declined for the past 2 years from 6.3 billion to 5.7 billion, which isn't too major. One thing that definitely has to do with that is their cash, which has dropped by about 800 million in the same time. So that is basically entirely, that drop is entirely from cash, and other assets have actually increased. For example, property, plant, and equipment going to 2.7 billion from 2.5 in the past year. So overall, everything's fairly solid. They've just been using a lot of their cash recently. So, no, not too big of a deal. However, again, in the past 2 years, we also have seen slowed earnings growth. So, hopefully, in 2025, especially, we can see some significant earnings growth from that massive cash investment. Looking into their debt, they do have a significant amount of long term debt. Their short term is completely coverable by their cash, which is good to see. That's generally a positive indicator. However, this long term debt is pretty big, 2.9 billion compared to 300 million in cash. Definitely something that should be minimized in the future. However, again, um, they do need to get some kind of reinvestment happening in order to kind of fuel future growth, because right now their net income growth, once again, going over this one more time, is not great. It's definitely something that needs to be addressed. Other than that, let's head into the cash flows, see what we're seeing here. So, first up, if it wants to load, is the operating activities. Sorry for that. Operating activities we could see have decreased in the past 3 years, going from 710 million to 586 million in operating cash flow. The funds from operations stayed relatively consistent. One thing we'll say is changes in working capital went from positive 94 million to negative 24 million. So that kind of accounts for most of that change. Also, a little bit more depreciation, but nothing too crazy there. Investing activities, we could see a lot of money spent on acquisitions, which I'm assuming is just them buying up kind of smaller ski resorts and adding them to their own portfolio of assets. Um, so it looks like that's where a lot of that money is coming from. And then also, of course, capital expenditures. They have sold some investments in the past year, which they have not done in a couple years now, which is could possibly be a change of pace for the company where they're kind of selling off less profitable things, which could be a good sign because again, we saw with their net income, it is decreasing. So hopefully they are getting rid of some less producing assets there. Financing activities, a lot of dividends paid. We did see their dividend get halted in 2021 with COVID, which honestly completely makes sense with this company. That was probably the smartest decision to do. Um, but other than that, their capital stock is consistently going down. Debt has been being reduced in the past 3 years, which is good. Before that, of course, they did have to take out a lot of debt with the whole COVID era, which again completely makes sense with the company. But overall, their cash flows look fairly solid. Free cash flow has always been consistently positive, which is good. And I think that's about it. We can visualize the sales growth here a little bit. You can see the dip during COVID, and it almost immediately recovered within a year. And now we're just seeing a little bit of slowed growth here. So hopefully that kind of makes a comeback in 2025. We'll have to see what happens there. But it looks like most of the hit between 23 and 24 was actually not really anything for the most part. They just basically stayed the same. There wasn't really any significant drops in revenue from anything specifically. But anyway, moving on, we'll hit up their ratios here. So one thing we're going to see here is their net margin decreasing. That is the biggest thing that they need to work on. So their 5-year average is 8.5. We're at 7.9 now. And in 2022, we saw a net margin of 13, almost 14%. So whatever they were doing right in 2022 and even 2023, they need to try to get back to that because their sales are much larger than they were then. Not so much 2023, but compared to 2022, their sales are a lot higher. and yet they're making significantly less money. Return on assets and equity both look really good. Both are above the 5-year average as well recently, which is good. Other than that, everything else looks solid across the board. Their debt ratio, though, is massive. 400% is not great. Either they just don't have a lot of equity or they have way too much debt, which is what I'm going to go with. And honestly, this should be back where it was in 2018, under 100%, right around 80%. I say this probably in every video. 80 to 100% is considered healthy. Anything higher than that is risky. And being at 408% is just not a good idea. Now, one thing to also say on that is their long-term debt to their total assets is at 51%, which isn't crazy. However, it's also above their 5-year average. Generally, you want to see that going down. So overall, definitely a bit of a problem with debt here. But anyway, moving on, let's try to see if we can find some information specifically for the company in their earnings reports here and see what we can see while it's looking up stuff. So metrics preview, metrics recap is what we want to see. So let's get into this here. Mountain beat estimates at 173, lodging beat estimates. Real estate came in slightly under, however, actually significantly under, but it's their smallest segment by far, so nothing major there. EBITDA beat estimates actually across the board, it looks like. And yeah, EBITDA beat every single metric. Skier visits dropped 16.7% year over year. That is rough. So actually, it completely makes sense that their net income is down because they lost 16% of their customers. I'm not sure what ETP, ADR, and RevPAR are, but all of those increase, which I'm assuming is positive. Revenue, rev means revenue. So revenue increasing whatever by just about 11% year over year is positive. But overall, skier visits down 16.7% is the biggest thing here. That is brutal for this company. Definitely extremely negative. That's going to be tough to come back from to get those customers back over the next year. One thing we haven't seen in a while is a street takeaway, which is where we look at the analysts that go over the company. A lot of companies don't have this, but this one does. So some things to look at here, targets being raised. 2 out of 3 that I'm seeing here have raised their targets from 217, 227, and one lowered target to 247. So all of them are significantly higher than the price now, which is good. But let's see some things. Year-over-year decline in skier visits was driven by weather in Australia and was widely known. So that is something that could be, but 17% when a lot of their resorts are also in the US, I think 17% is way too big to just be that. Now, one thing we can look into to kind of fact check the stuff I'm basically making up right now is their revenue. And yeah, only 6% of their revenue comes from Australia. If they lost 17% of that, their Australia revenue would be zero. It would be 0%. So a lot of those skier visits have to be from the US and Canada. So that entire opinion doesn't make sense. Believes past sales exceeded expectations, which makes sense. Other than that, cost savings outlook is positive. That's good. Good operating conditions in the summer for North America. Difficult conditions in Australia were known. Once again, still 17% decline in skiers, 16.7. That doesn't make up for just being Australia. So that is something to think about. Like, yes, conditions could be bad there, but only 6% of their revenue comes from Australia. So it had to be from North America as well. That's all I'm going to say there. But anyway, other than that, let's get into their chart now and see what's going on. So this is their chart for basically their entire history of being public. And one thing we could see here, if we scroll to the right a little bit, is they have been in a downtrend for about 3 years, which makes sense because this company definitely got very heavily affected by COVID. And just zooming in a little bit more, there really isn't too much solid support. You could say that this bottom here would be a support, but honestly, there's not really any multiple hits on a trend line anywhere to suggest that. So the best thing I could find is just the double bottom recently over the past couple months. And if we zoom out to the daily chart, we could kind of see that a little bit better. Um, Again, I honestly think that 16% drop in customers is probably the biggest thing, biggest news out for this company right now, and we might see them go lower than this. It honestly wouldn't shock me to see them go even lower than this. But again, it's really just up to what the market wants. Now, some of those analysts did have positive things to say. They had their price targets right around 250, but I really think that that drop of customers is a lot bigger than what they said it was. And I can't imagine the company going too much higher than it is right now, at least short term. So that's all I have right now for Vail. Hope you enjoyed. Hope you learned something. Make sure to subscribe if you haven't, and I will see everybody in the next video.